Welcome back to Discover Crypto. It's a stormy day here in Ireland, and I think that's a perfect metaphor for all of the recent retracements in price and all of the volatility we've been going through since last week, and which was hinted at from the week before. I think now is a good point for me to go through a little bit of my history on getting into crypto, and I'm going to share with you 15 lessons that I've learned and that I feel that have helped me become better at investing and trading in crypto. However, please remember that I'm not a financial advisor and that this is not financial advice. I'm only intending this as a learning exercise. And just, if it helps you, that's all well and good, but I'm not giving it out as advice. Most important for me is security. Reputable exchanges such as Coinbase and Binance have security tools that you can use to beef up your accounts. I think the best thing to do, in my opinion, so I've installed the Google Authenticator app on my smartphone, and I've linked this to each of the centralized exchanges where I'm registered, and this generates temporary 6-digit PIN codes that are required for logging into my account. It can't be done without this. Basically, in crypto, if you're not secure, then you're going to stand a chance of losing no matter what you do. Also, in regards to seed phrases, I never share a seed phrase unless I'm specifically intending to import my wallet, such as when setting up an app or something that I have decided to do. Seed phrases can give outsiders full access to all of your funds. Therefore, you need to be very careful with how you choose to share that. Okay, I feel like leverage is important because leverage is quite often what causes market crashes in crypto. People borrow too much money and then their accounts get liquidated, and this causes all of the prices to cascade downward and makes life more difficult for all the rest of us. I have never used leverage and I never will use leverage. I'm not a professional trader who is an expert in technical analysis. Therefore, I don't use it. The use of leverage requires collateral. A sudden increase, depending on whether someone is longing or shorting, it can cause, and if they're using something like 10x, they need to put up their entire account as collateral. And technically, on some short trades, it can potentially be possible to have infinite losses. So this can cause an entire account to be liquidated in the space of minutes or seconds. And these liquidations will cause entire accounts to be lost. These people cannot live to fight another day, whereas those of us who maybe take a 10 or 20% drawdown in a day, we're down a little bit, but we can wait out those drops and potentially add to our stacks and come back stronger in the future. Volatility. I have accepted the crypto market is volatile, and I believe that everyone else should do this as well. Volatility is what makes it profitable. However, we can face those red days when there are 10 to 30% losses on major coins, and those losses can be even worse on the small cap alts. I take profits on the way up on my strongest performing coins. This lets me then sell my higher entry prices, and I can then choose to potentially buy back if the prices dip back down. This, I feel, offers me greater protection. And when it comes to dips, I'm not the type of person who just buys every dip, or BTFD, as some of the crypto Twitter people would say. But I pay the most attention when I'm seeing dips of like 20% upwards. Sometimes, the smaller dips can be followed by larger ones, and it doesn't always make sense to get in on every dip because then you're using up all of your spare capital. When it comes to volatility, I see this as counter trading. So basically, I'm trying to sell green and when things are going well, and then I'm buying when things are red, even when you're not feeling so good about the market. Because whenever you're buying those lower prices, you're having the chance for greater profits in the future. So with FOMO, I always ask myself, is this a blind investment I'm making just based on the fact that I'm seeing high price increases? Has the price increased by many multiples? So are we past 100% and we're talking 2x, 3x, 4x? I'm at risk of buying the top at this point. This might be around the all-time high. This might have set an all-time high. I try to just monitor these sorts of coins for days or even weeks afterwards, just to show myself and remind myself that nothing stays up forever and price retracements can happen. And as I learn more about a project, I might actually be less keen on investing in it, because whenever you look under the price movements, you might actually find that you're not really interested, there isn't a good use case, and that maybe there are some shady investors involved. When it comes to use case, I want to know what the project does. As an example, is it a layer 0, layer 1, or layer 2? And I recommend that you go out and learn some of these terms to familiarize yourself if you're not already. Is the project involved in decentralized finance, gaming, NFTs? Is it software or infrastructure? Does it stand a chance of adoption? Is there a better competitor out there? Which chain do the projects operate on? For example, if it's an Ethereum project, it's going to face high gas fees until, or if ever, Ethereum 2.0 is released. As an example, I'm giving you here with an NFT marketplace running on Ethereum or an Ethereum sidechain, this is going to have to compete with OpenSea, and OpenSea is the dominant NFT marketplace. So just because a project says that it does something, it might not be able to do it well. So I use coinmarketcap.com to check the circulating supply of every project I invest in. Coins with higher supplies typically reach lower all-time highs. For example, Kusama has reached an all-time high of just over $623, while Polkadot has reached $55. Comparatively, KSM has a circulating supply of 8.47 million versus 987.579 million for DOT. So because there's a higher circulation of Polkadot, it reaches a lower price overall. So whenever you're buying any coin, the price potential will be determined by the circulating supply. And you will quite often find that some tokens, especially meme tokens like Doge or Floki Inu, will have many billions of tokens, and so they're not actually going to reach that higher price no matter what any of the influencers might say on TikTok or any of the other platforms. With regard to market cap, this is a term where the value of a project's circulating supply of tokens is multiplied by the current price. For example, 10 million tokens multiplied by a $10 price would equate to a $100 million market cap. Market caps aren't static and they can fluctuate with price changes. When it comes to locked tokens, some projects only launch with a small percentage of tokens unlocked, and this can artificially increase the token price and market cap, only to fall in later days. I like to check the circulating supply against the total supply for every project I buy into. If you're looking at CoinMarketCap, there can also be a valuation for fully diluted market cap, and basically this multiplies the total supply rather than the circulating supply with the current token price. And if you see a massive difference between the two, then this can potentially be, a concern, because whenever locked tokens come on the market from seed investors and venture capitalists, this can lead to big sell-offs. It can create sell pressure, and this basically suppresses price and lowers its potential. When it comes to investor lists, I would say you need to be wary of these. Some projects will show an array of logos from different investors as if this somehow provides authenticity. I think it's more like eye candy at times. Venture capitalists are renowned for spraying and praying. Some of them, they might throw $1 million each at 10 projects, and the one that succeeds goes 100x, and then it basically pays for all the failures. Whereas that is not such a viable strategy for the everyday investors like you and I. I only see quality investors as the cherry on top. I don't like to see it as a reason alone for getting involved myself. I like to know the use case, the token supply, whether there are unlocks coming, and you can quite often find information about that in white papers for projects. If I am seeing a quality project and that happens to have blue chip investors, that's quite often what can tip the balance for me. I see it as a cherry on top. If I'm looking at quality investors, I'm thinking the likes of Alameda, Coinbase, Pantera, Arrington, Hashed, Three Arrows, and Multicoin. I mean, there are some other good ones, but then there are networks of less reputable ones. Dollar cost average, or DCA, is a term that you often come across in social media when looking at crypto. Whenever dollar cost average, it basically means, in my case, I like to routinely invest into my longer term bags by buying on down days, by spreading out my investments. It means that, I can potentially buy in more for less later on, and avoid like buying in all at once whenever the price is high. Dollar cost averaging can also be simplified. Like some people who have a Coinbase account might do it more blindly, where they just simply choose to buy $50 per week into Ethereum or Chainlink or Bitcoin or something like that. But dollar cost averaging can actually be coordinated by monitoring price movements as well. When it comes to deploying capital, I never go all in. I don't see this as a poker hand. I also try to avoid spreading myself too thin. I also try to force myself to reevaluate my more speculative trades and sell if they don't go well. Like, for instance, last week, heading into Thursday night, I was feeling very disappointed with how DeFi had performed in Q3 and Q4 of 2021. And I simply decided to cut loose nearly all of the DeFi projects I was holding, because I simply didn't think they'd been performing well. And, gaming is doing much better right now. Other projects are doing much better right now. So I can always come back later if there's a change in how DeFi is performing. And also there's a lot of risk now in DeFi, after all, with the US government looking at how things are going. And basically, I think it's important to admit defeat when an idea hasn't worked out, because the capital might actually end up doing better if you put it into something else, into a stronger project with what has a current hotter narrative. And this is all about transferring your crypto smartly. Like, for instance, say you have an account on one exchange and you want to go to another one, you're going to have to deploy funds there. USDC is a popular stable coin mimicking the dollar. However, it's on the Ethereum network and can incur high transaction fees when it's sent between exchanges. Alternatives in this example would be USDT, providing it's sent over Tron or TRX. There's BUSD, which can be sent over Binance Smart Chain, and UST, which can be sent over Terra. And basically, you can save yourself money by transferring smartly. I mean, at the time of recording, it was $24 to send USDT over Ethereum, where sending USDT over the Tron network was only $1. So whenever you are trying to transfer your funds to another exchange and you're going into the wallet there and the deposit option, you need to find your exact address, see if there's any memo required. And before doing a transfer, you always need to check that you've selected the correct token to generate the correct address, look for any memo, and all this information, and select also the correct network. All of this information needs to be carefully input and confirmed, double checked, even triple checked before confirming, because FTX is one of the best exchanges for helping out customers in my experience, but I've heard that some of the other major ones are not so good at helping to fix mistakes that are made by users. So please be very careful. You would rather not have to ever contact customer service by getting it right and being a little bit more careful. Taking profits. I have to say, go to Google and look up profit-taking strategies for trading and investment. I cannot do this for you. I cannot select this for you. Your decisions are going to be unique to your own circumstances. You need to see what options exactly are out there and make your own mind up on this matter. In crypto, nobody will succeed with hand-holding. You need to learn and do things for yourself. Otherwise, you will not succeed in the long term. Though I will shed light on a couple of options here. So I've heard plenty of people, they love taking an approach where, they might sell 30% into Bitcoin, 30% into Ethereum, and then the remaining 40% into stable coins. Not everyone does this. That's just what some people choose to do. Personally, I like to maybe sell 5 or 10% if I'm seeing big daily increases of 25% upwards of maybe my highest entry price. And whenever I log all of my tokens, and what I like to do is I try to mark off or sell off my highest entry prices first. Like, say maybe I've got 200 tokens in a project and 50 of them are, in a relatively high price, say the price increase is 25% above my highest entry price, I'll maybe sell off those 50, and then that gives me a lot greater protection if price pulls back, even below that highest entry price. I've now moved it off my books, and maybe this even gives me an opportunity to then rebuy those 50 or even more at a lower price. Basically, logging all of your buys and sells will give you a much clearer picture of where you are. I would be lost without that strategy. So reassess. I always think it's important to maybe every week or every few weeks on maybe some of my bigger or more speculative trades, I like to reassess. In the early autumn or Q3 of 2021, I was thinking that, surely decentralized finance is going to have a good run here. But the fact of the matter is US regulators, including Gary Gensler, they have DeFi in the crosshairs and want to apply regulation to it. And I think this is stymieing the progress, and it's stifling the excitement surrounding DeFi. So therefore, we haven't seen big price increases like we have in gaming and metaverse. So anyone, and I was included, I started to rotate out of some DeFi and get more into gaming and metaverse and prioritize those, because not every project is a Luna, which can thrive even when the rest of its sector is cold. And I'm pretty much mostly out of DeFi. I am in some Oracle projects because they have utility beyond DeFi as well, and they are functional, and I do like them, and they do have adoption. So I'm quite still happy to hold those, but wider DeFi is a concern for me right now. I would say whenever you're assessing progress, you maybe go back and look at your projects every few weeks, check that there's development. I did a video recently monitoring the development of some of the coins I'm invested in. Has there been progress? Has there been announcements? You can go to Twitter, see if they've got a Medium page, which can usually be found by coinmarketcap.com. You can get involved with some of the, maybe not Telegram, but then quite often there are other communication tools that a project might have. You can go register, get involved, chat, see if anything's been going on. Also, whenever you're looking for development, also look for news and reputational things. Like, are people saying anything bad about projects? Have there been any hacks, like on a DeFi protocol? I mean, if there's been a major hack on a DeFi protocol, all of the prices come down, there might be less interest in it, and this might, you might not see progress until things have recovered or fixes have come in or audits have been completed. And it might actually be a good time to get out with maybe 60% or 70% of your entry price, rather than sitting and holding and have it potentially grind down even lower. I'm going to follow this last slide up with a quick demonstration, because basically I find candlestick charts fundamental. I think it's very important for every trader to understand them, at least to a basic degree, because I feel like I would have stunted my progress in crypto if I didn't learn this skill. There are different time frames. Some of the more common ones people look at are 15 minutes, an hour, 4 hours, 1 day, 1 week, 1 month. But there are a bunch of other hourly options in there, and even minute options. Low time frame, if you ever hear the term, this refers to shorter time frames, such as 15 minutes up to an hour. High time frames, you would maybe classify 4 hours upwards, and that's for longer term periods. When you're looking at a green candle, these open at the bottom of the body of the candle, and they close at the top, whereas a red candle opens at the top and closes at the bottom, and this applies to a time period. So if you set your chart on 4 hours, that's for all of the trades in a 4-hour candle. Whenever you see a wick, this is the tiny thin line that rises above and below the candle, and this basically represents the highest point and the lowest point that the price has been during that time period. When you're looking at charts, it's helpful to identify if the peaks in the price, you're seeing like higher highs and higher lows. I'll try and show a better example in an actual chart. And support and resistance are also important. This is a longer time frame view. On TradingView, I've set this up on 1 day for Polkadot. There are some more complex tools at play here, but basically I'm going to go to the 1 day. I'm going to go to 4 hours. And I'm going to increase what we're looking at here. Right, so if we see the way there's this upper range here, this is resistance. So the price is coming up, say to here, it's meeting resistance, it's not breaking through, and it's coming down, but it's not going any lower. So it's finding a base of support. So the price goes up, hits resistance, comes down, finds support. And you can also find that some of these price movements, they can basically be meeting a trend line. So if we can see here, the polka dot price isn't punching through a trend line here on the 1-day chart. Whereas some past examples, I've got a trend line here. Price punches up through the trend line. And what I would also say before, because I'm not going to go into too much depth here, I'm just showing really some of the basics. So this candle here, it's a red candle. And unless someone has changed their settings, you assume a red candle is a negative and a green is a positive. So for this red candle here on the 1-day chart, go to the top. That is where the price opened for this day, which is the 4th of December. And that is where it closed on the 4th of December. There isn't much of a wick above, but there's just an ever so slight amount of that is the highest price it was on that day. And at this wick here on the very bottom, that is the lowest that the price was on that day. Now, if I'm looking at at the time of recording on the 7th of December, on this candle here, so this is where the lowest price is, where the period opened, and this is where it is currently at the time of recording. If it's a green day, it'll close above the open. However, if things go south from here on the 7th of December, it could end up being a red candle. And so the open here, it ends up closing down here. So whenever you're looking at dollar cost averaging or trying to apply some price analysis, it helps to come out and look at things in a longer time frame. Put on a 1-day chart rather than 4 hours. And then whenever you're seeing price shoot up and you're deciding not to FOMO, you're going to monitor how things come, you might end up getting in for less. Because if you're a long-term polka dot buyer and you're getting in under $40 here, you know what? It's already a win compared to potentially buying more than $50. And then if you haven't spent all of your money or deployed all of your capital and you got in on this run down here, you've got another lower entry price. And by adding those prices together, dividing all of your tokens, you're getting an average entry price. And this can be very, very helpful for long-term investing because you're not deploying all at once and you're not risking all of your capital. So just to recap, those are my 15 lessons that I've learned from crypto trading. Maybe there's something in there to help you, maybe there isn't. Just remember that it's not financial advice. I have been using this day after the recent crash with some increases. I've been taking some more profits. I've been taking profits for a couple of weeks now. This is to make sure that I'm continuously rotating my portfolio. I'm cutting back if things are getting too spread out. I'm then deploying my capital into some of my longer term projects that have come down in price. In my recent video with the 5 updated coins, I've actually reinvested in all of those. So I've seen this pullback as an opportunity to lower my average entry price, build my bags in those areas. And that's what crypto is all about. It's all about buying red and selling green. Success isn't determined by doing it the other way around. This can be very difficult. This can be mentally taxing. I do have anxious days myself, but it's important to have a clear strategy. Take it easy. Don't get emotional. Have a plan and stick to it. Because if you're not ready for the volatility, then crypto, it might not be for you, and that's perfectly fine. Because there's a lot of promise in crypto, but there's also a lot of failure if it's not done properly. But anyway, I thought it was important to come back to you all and maybe share some of my insights to maybe help you through these more difficult periods. I've gone through a number of them now myself, and by having a plan and a strategy and following some of the lessons I've learned, it has helped me move forward. So yeah, please like and subscribe if you've enjoyed the content. I'm also on Twitter. I've got links shared in the description. And I think I'm going to come back with my next video covering Efinity. It looks like Efinity is going to be a major competitor for that fourth parachain slot, and it's a metaverse project. So I'm interested in that. So I think I'm going to come back and cover that before the second batch of auction candidates are announced. But yes, I've been Mike, and thank you for watching Discover Crypto.